Most people have money in the stock market without understanding how it actually works. They invest because someone told them to. They panic when it drops. They celebrate when it rises. But they have no idea why any of it happens. Today, that changes. Because once you understand how the stock market actually works, you will never look at your money the same way. Here is the simplest explanation that nobody ever gave you. A company needs money to grow. Apple wants to build a new factory. Amazon wants to expand its warehouses. Google wants to hire more engineers. They have two choices: borrow money from a bank and pay it back with interest, or sell small pieces of their company to the public. Those small pieces are called shares, and the place where those shares are bought and sold is called the stock market. When you buy one share of Apple, you own a tiny piece of Apple. Not a building, not an office, not a product. A piece of the entire company. Its profits, its growth, its future. And as Apple grows, your piece grows with it. That is the entire idea. You become a part owner of the most powerful companies on the planet for the price of a single share.
So why do stock prices go up and down? This is where most people get confused, and it is actually very simple. Stock prices move based on one thing: what people believe a company is worth. Not what it is worth today, what people believe it will be worth in the future. If millions of people believe Apple will sell more iPhones next year, they want to own a piece of that future profit. So they buy shares. More buyers means more demand. More demand means the price goes up. Now imagine Apple releases bad news. Sales are down. A competitor is winning. People believe Apple's future is less bright. They sell their shares. More sellers means more supply. More supply means the price goes down. That is it. Supply and demand, applied to ownership of a business. Nothing more complicated than that. Now here is what most people get wrong. They watch the news. They see the market drop 2%, and they panic. They sell. They lock in their losses. But here is what the data shows. The stock market has gone up in 73% of all years since 1926. 73%. That means in 7 out of every 10 years, the market finished higher than it started. The drops are temporary. The growth is permanent. Every single crash in history, 1929, 2008, 2020, the market recovered. Every time, without exception.
So how do you actually invest without picking the wrong stock? Because this is the question everyone asks. What if I pick the wrong company? What if I buy Apple and Microsoft wins? What if I invest in the wrong thing? Here is the answer that changed everything for ordinary investors. You do not pick one company. You buy all of them at once. This is called an index fund. An index fund is a single investment that holds shares in hundreds or thousands of companies simultaneously. The most famous is called the S&P 500. It holds shares in the 500 largest companies in America: Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Johnson & Johnson, all 500 in one investment. When you buy one share of an index fund, you own a tiny piece of all 500 companies at the same time. If Apple has a bad year, Amazon might have a great year. If one company fails, 499 others keep going. Your risk is spread across the entire American economy. Not one company, not one industry, the whole economy. And the S&P 500 has returned an average of 10% per year for the last 100 years, through every war, every recession, every crisis. 10% every year on average. A $10,000 investment at 10% per year over 30 years becomes $174,000 without picking a single stock, without watching the market every day, without any expertise whatsoever.
So how do you actually start? Step 1. Open a brokerage account. In the US, Fidelity or Vanguard. In India, Zerodha or Grow. Free to open, takes 15 minutes. Step 2. Search for a total market index fund. In the US, look for VOO or VTI. These track the S&P 500 and the total US stock market. In India, look for Nifty 50 index fund. Step 3. Decide your monthly amount. It does not have to be large. $20 a month, $50 a month, whatever you can consistently invest. Consistency matters more than amount. Step 4. Set up automatic investment. Same amount, same day, every month. And then, do nothing. Do not check it every day. Do not panic when it drops. Do not celebrate too much when it rises. Just let time and compound interest do the work. Because here is the truth nobody tells you about the stock market. It is not complicated. It is not reserved for experts. It is not only for the wealthy. It is a system designed to grow money that has worked for 100 years and is available to anyone with an internet connection and 15 minutes to open an account. The only thing standing between you and that system is the decision to start. If this video finally made the stock market make sense to you, subscribe. Next week, I am going to show you exactly how to build your first investment portfolio from zero. Step by step. No jargon, no complexity. Just a clear, simple plan. See you there.